When traders look at a candlestick, they often focus only on the color, green or red. But one of the most important pieces of information inside every candle is something incredibly simple: the open price. The open price is the very first price at which the market trades during a new session. And even though it sounds basic, it's actually one of the clearest clues about market sentiment, momentum, and who is stepping into the fight first, buyers or sellers. Let's make it simple. Imagine the open price as the starting line of a race. As soon as the candle begins, price jumps forward, and the open marks exactly where that race started. Everything the candle does afterward, how far it moves and how strongly it pushes, whether it rises or falls, happens in relation to that opening point. In a green candle, price opens at the bottom of the body and closes higher. That means buyers took control after the open. They pushed price up and kept it there. In a red candle, price opens at the top of the body and closes lower. That means sellers overpowered buyers after the open. But the open price isn't just the first tick on a chart. It represents the transition between sessions, between yesterday's and today, between low volume and high volume, and between calm and volatility. When a new candle opens, especially on larger time frames like the daily or the weekly, it often reflects the market's reaction to news, expectations, or overnight sentiment. Here's an easy real-life analogy. Imagine a store opening its doors in the morning. The first customer who walks in sets the tone. If they buy something immediately, momentum feels positive. If they come in angry and complain, the mood shifts instantly. The open price works the same way. It's the first footprint that sets the tone for everything that comes next. The open price also helps you understand where liquidity is resting. Many traders place orders around the open. Algorithms track opens. Institutions compare today's open to yesterday's close. If market opens above yesterday's close, it tells a different story than if it opens below it. These tiny details shape the character of the entire session. Let's talk about gaps, something directly tied to the open price. A gap happens when the open price is significantly higher or lower than the previous candle's close. This usually happens after major news or during weekend breaks in markets like stocks and crypto. A gap up means buyers were extremely aggressive before the session opened. A gap down means sellers were in control. The open price also acts as a natural reference level. Think of it like a line in the sand. If price stays above the open, the session is considered bullish. If price stays below the open, this session is considered bearish. Many professional traders use this sample concept to understand intraday sentiment. In smart money concepts, the open price plays a special role because it's tied to session identity. The daily open, weekly open, and monthly open become high probability areas for liquidity sweeps, manipulations, and institutional positioning. When price rapidly moves away from the open, grabs liquidity, and displaces in the opposite direction, it often signals the true direction of the day. Let's make this very real with a simple scenario. Imagine the daily candle opens at a certain price. Immediately, you see a fast move downward. Big wick, strong rejection. What happened? Sellers tried to take control at the open, but buyers stepped in hard and forced price back above the open. That wick below the open wasn't random. It was liquidity grab. Traders who know how to read open price behavior can catch that reversal early. The open price also helps traders define bias. If price is consistently trading above the open throughout the session, the market is favoring longs. If price remains below the open, shorts are favored. It's simple, but incredibly effective. Professional firms and prop traders use the daily open as a line of truth. Even the time of day affects the open price. For example, during the New York session open, volatility increases. The London session open brings momentum to forex pairs. The stock market open triggers strong volume spikes. Understanding how the open interacts with these dynamics helps traders anticipate volatility instead of reacting to it. Let's summarize everything through a simple story. Imagine the open price as the first chapter of a book. You don't know the entire plot yet. You don't know how the conflict will unfold. But that first chapter sets the tone. It tells you where the story begins, who steps in first, and how the initial energy feels. The market does the same thing. The open price is the beginning of each candle story. And once you learn to read it, the rest of the chapter makes a lot more sense. To summarize, the open price is the first traded price of the session. It reflects sentiment, liquidity, and session tone. It becomes a natural reference for trend and bias. It plays a major role in gaps, reversals, and smart money concepts. And it's one of the simplest yet more powerful tools for understanding true market behavior. Candlesticks tell stories, and the open price is the very first word of every story. Learn to read it, and everything else becomes much clearer.